Hello traders, this is Simon, and in today's video I'll be making a playlist that contains all the whole information a beginner trader needs to become a professional trader. So I am starting a playlist on my YouTube channel. This particular playlist will contain all the whole teachings, all the whole informations you need as a beginner trader, from beginner to advanced trader. So I am just starting the playlist today. This is the first video I'm making on that playlist. So the concept of this video is online ICT forex trading mentorship, beginner to advanced. So if you are looking forward to become a forex trader and you don't have the money to pay for mentorship, I got you covered, because in this channel, in this playlist, all the whole information you will need from beginner to advanced, you will find them there. So I'll be starting. The first level is level 1, that is beginner stage. The topic there is foundations of forex and ICT concept. Then I have module 1 here, that is where we are starting from, module 1. Then the topics I have here, I have number 1, the A. I have what is forex and how the forex works. B, currency pairs, tips, lots, leverage, margin. C, brokers, liquidity providers, and trading platforms. Then lastly, types of orders, that is market, limit, and stop orders. So in this video, I'm going to cover these 4 topics here, which is found under forex basis. So pay attention. If you are a beginner trader, you have to pay attention. Watch this video from the beginning to the end. Okay, let's start from this first one, forex. What is forex? Forex, which is the short form of foreign exchange, is the global market where national currencies are traded against one another. It is the world's largest and most liquid financial market, operating 24 hours a day and 5 days a week. Forex trading is just a way of you buying different countries' national currency. Just for example, now you have USD, which is the United States dollar, and you have GBP, which is the Great Britain pounds. You see that it's either you are buying one over the other. You simultaneously buy one and sell each other and sell the other one. So whether you have been into forex or not, in one way or the other, you have done what we call foreign exchange, because you must have exchanged your local currency to another one. So a process whereby you exchange your own local currency to another currency, you've done what we call forex trading. You have done foreign exchange. You understand? But that one is physical foreign exchange. But this one is now online forex exchange. So forex is the largest and most liquid market we have worldwide. So you are just, the only thing you do, you do two things in forex trading. It's either you are buying one currency or you are selling the other one. And the way this thing works is that these currencies, they are being traded in pairs. They are being traded in pairs. So you can say that one is going to gain value and you buy it, and you say the other one is going to depreciate in value, then you sell it. So the only two things you are doing in forex trading is buying and selling of national currencies. That is what you do in forex trading. Then, how does forex trading work? You see that forex trading, it is being traded in pairs. Currencies are always traded in pairs. When you trade a pair like Euro USD, you are simultaneously buying Euro while selling USD. I don't know if you understand what I mean. When you are trading in pairs, currencies are being traded in pairs. You don't trade them singularly. They are being traded in pair. You have GBP USD, you have Euro USD. So if you are trading Euro USD, for example, it means you are simultaneously buying Euro while selling USD. If it is GBP USD, you are simultaneously buying GBP USD while selling USD. This is how it works. You understand? So that is for the first one. You can see, go back again, read more about the definition and other things concerning forex. This is not going to waste our time. Then we come to the B aspect of it: currency pairs, pips, lots, leverage, and margin. That's the second one now that we are entering. The second one. First of all, currency pair. We have 7 main currency pairs, 7 major currency pairs. There we have also minor currency pairs, but the major currency pairs we have, there are 7, and they are grouped as Euro USD. That is the first one. Secondly, we have GBP USD. Thirdly, we have USD CAD. That's USD, United States dollars, and Canadian dollar. Then we also have USD JPY. JPY is Japanese yen. We have USD CHF. That is dollar versus Czech Republic. Then we have AUD USD. That is Australian dollar versus United States dollar. And lastly, we have NZD USD. That is New Zealand versus US dollar. These are the 7 major currency pairs we have. Let me repeat it: Euro USD, GBP USD, USD CAD, USD JPY, USD CHF, AUD USD, and lastly, NZD USD. These are the 7 major currency pairs we have. You understand? We also have other minor currency pairs, but we are focusing on these 7 major pairs. Then let's go to the second one: pips. What is pips? In forex trading, pips means percentage in points. This is the smallest unit of price change for a currency pair. The smallest price change you have in a currency pair. If, for example, that is the smallest movement, let's say that a price move from point A to point B, or point I to II, you say that we've gotten a pip. You understand? So that slightest difference, that movement from one level to another is called pip. So most commonly, pip represent a movement of 0.001. That is any what is it called? Any currency pair that is associated with dollar is being calculated as 0.0001. Any pair that is paired with any currency that is paired with USD, this is how the pip looks like. So if you have 0.0002, that is a pip. You understand? Formerly we were having 0.0001. So from 0.0001 to 0.002 is a pip. You now have a movement, you understand, from 1 to 2. So from this to this is 1 pip. So the smallest movement is what we call pip. The third one is lot. Let's look at lot sizes. Okay, lot. This is a standardized amount of currency unit traded in a single transaction. It is a standardized amount of a currency unit that is traded in a single transaction. It is used to quantify the size of a trade. If you are taking a trade now, for example, you are taking a Euro USD, the quantity of Euro USD you are going to be buying will be determined by the lot size you are using. The four main lot size we have are the standard lot size. The standard lot size represents the 100,000 unit. If you are using a standard lot, then you are, for example, Euro USD. If you are buying a Euro USD with a standard lot, then you are buying 100,000 quantity or 100,000 unit of Euro USD. That is the meaning. Then we have the second one, mini lot. That is 10,000 units. If you are using what is it called? Standard lot is represented as 1.0. This is standard. You understand? Then we have the mini lot, which is 10,000 units, which is represented as 0.1. This is the mini lot size. So if you are using 0.10 to buy Euro USD, it means you are buying 10,000 quantity or 10,000 unit of Euro. Another one we have is micro lot. If you are using micro lot, it means you are buying 1,000 unit or 1,000 quantity of Euro USD. And this is represented as 0.01. Then lastly, we have the nano. The nano is not all broker. It's not all broker that has this nano, because nano is 0.001. You understand? So if you are using nano now, it means you are buying 100 units of that particular currency. So lastly, lot size or lot determines how many quantity you are going to be buying or selling. That is the work of lot size in forex trading. Then another one we are going to look at is leverage. What is leverage? Leverage in forex trading, this is a tool that allows traders to control a large position in the market with a small amount of their own capital borrowed from a broker. Let me break it down. Leverage now is what, let's assume if you are having your own capital as maybe $1, for example, and a broker provides, because broker is the one that provides leverage, a broker provides you with a 100-to-1 leverage. It means that for every $1 you have, you'll be trading with $100. What broker does is that what leverage does is that leverage is the money the broker borrows a trader to trade, to amplifies the trader's buying power. But the leverage does two things. Leverage can amplify your profit and also amplify your losses. Okay, let's take for example, 100 to 1 leverage ratio means that for every $1 of your own money, you can control $100 worth of the currency pair you are trading. Without leverage, it will be very, very hard for us to be able to trade. That is why, so the only money you need to deposit, you deposit money, that which is a margin. When you register with a broker, you deposit money. Then that money you deposit will be amplified with the leverage the broker is going to give you. The leverage now is like a loan given to you by a broker. You understand? So let's look at margin. Margin is that amount you needed to deposit. This is the amount of money that a trader must deposit with a broker to open and maintain a leverage position. You understand? Once you have registered with a broker, you need to deposit some sort of money, some sort of capital. It could be $1, it could be $5, it could be $10. You understand? This is the money you needed to deposit before you can be able to make use of a broker's leverage. Then we go to the C part of it. We have broker, liquidity provider, and trading platform. I made mention of broker before. A broker is a financial service company or firm that acts as an intermediary between individual retail traders and the global foreign exchange market. So, broker serves as a middleman or a middle personnel between a retail forex trader and the forex exchange market itself. So without the broker, a retail trader cannot be able to trade the forex market. So broker is the intermediary, the middle personnel between the trader and the forex exchange market itself. Then we look at liquidity providers. Liquidity provider, which is the LPS. These are major financial institutions such as large banks and specialized firms that supplies the necessary capital and currency reserve to ensure smooth and efficient market operations. They essentially make the market. These are the market makers. They are the one that makes the market. They are the one that moves the market. They essentially make the market by always being ready to buy or sell currency pairs, thus facilitating the trades for brokers and individual traders. These are for liquidity providers. They are the one that makes the market. They are the market makers. Then lastly, we talk about trading platform. Under this trading platform, we talk about MT4, MT5, and TradingView. MT4, MT5 is where after we've registered with a broker, this is where you log in your details. Okay, after you are done registering with a broker, then you go to your phone and download MT4 or MT5. Then you input the information giving you, the login details given you by the broker. You insert it into your Meta 4 or Meta 5 and you begin to trade. Or you can also use your system, your laptop or your desktop. You download Meta 4 or Meta 5 and you log in the details and be using it to trade. Like my own now, this is MT5. You understand? This is MT5 that I'm using to trade on my laptop. You understand? So Another one is trading view. Trading view is you use trading view for analysis. This is where you do your analysis. You understand? You do all analysis on trading view. Then after your analysis on trading view, you now come to your MT4 or MT5 to take the trade. Let me show you an example. This is how trading view looks like. You go to search bar, you search for trading view. Look at it here. This one, you look at it. This first one, you enter this first one. Then you have to sign up. You understand? Like me, I already have my email here. You understand? So you can continue with your email. If I choose to continue like this now, we'll continue. But I already have it. I am already logged in here. So you understand? I cannot look at. Let me open a chart now to show you. I click on this chart now, then I expand the chart. Are you seeing it now? This is a chart now. I can do all the analysis here now that I want to do on this trading view. I can do any analysis here now. You understand? So MT4, MT5 is for taking trade, then trading view is for making analysis. Okay, let's go to the last one, type of orders. We have market orders, we have limit order, and we have stop order. These are the three orders we have in the market. The first one, market order. In some broker, you see it as instant execution. You understand? This market order, this is an instruction. It's an instruction to buy or sell a currency pair at the available price immediately. This one does not waste time. You buy or sell instantly at the current price. So if you choose market execution or instant execution, it means that you are telling the broker to just execute your order immediately without wasting any time at the current available price. That is where the broker will execute your instruction. It is the default and common type of order. It is used for quick entry and exit. Very, very simple. Then the second one is limit order. Limit order is a pending order to buy or sell a currency pair at a specific price or better, providing price control and acting as a risk management tool. So limit order does not work like market execution or market order. Limit order is you set out the price you want to buy from, you want to buy at. Maybe you want to buy below the current price action, or you want to buy above the current price rate. Sorry, you want to buy below the current price rate or above the current price rate. That is when you use limit order. Then we have buy limit order and we have sell limit order. This is now under limit. We have buy limit order and we have sell limit order. Buy limit order is placed below the current price, below the current market price, to buy at a more favorable rate or lower. You understand? If you are buying with buy limit order, you are buying below the current market price. This is how maybe you don't want to be on your chart, and you don't want to miss the trade, then you use this pending order that when market gets to this level, buy. That is what buy limit order is used for. Then we have sell limit order. It is placed above the current market price to sell at a higher rate or better. So buy limit order is set below the current price, while sell limit order is set above the current market price. Then lastly, we have the stop order. Stop order are instruction to a broker to automatically buy or sell a currency pair once each price reaches a specified stop price. You are giving a broker instruction to automatically, whether you are there or not, automatically buy or sell a currency pair once it gets to a particular price determined by you, set by you. Then we have two main types of stop order. The first one is stop loss order. Stop loss order. Stop loss order is used to limit potential losses on an open position. So if you have an open position already on MT4 or MT5 and you don't want to lose more than a specified amount, then it is stop order you use to give instruction to the broker that maybe if this market goes against my direction at $5, cancel my order, remove me from the market. I don't want to lose more than $5. You understand? That is where stop order comes to play. Then we have a stop entry order. Stop loss order, stop entry order. Stop entry order used to open a new position once the price reaches a certain level, typically to capitalize on a breakout or a continuation of a trend. So stop entry order, now we have two types: a buy stop order and a sell stop order. You know, some traders they do breakout trading, that when price breaks a particular resistance or a particular support or just a particular level, a particular strong level, that market the broker should buy for them whether they are there or not. So a buy stop order is placed above the current market price to go long, that's to buy, to go long when the price breaks a resistance. That is for a buy stop order. While a sell stop order is placed below the current market price to go short when the price breaks support. So buy stop order is used for resistance, when market breaks a resistance. Then a sell stop order is used when market breaks a support. This is it, guys. I want you to also go back and also, apart from this video, also make some researches and also practical aspect of this thing I have talked about, because this is the beginner level, beginner stage. The next video I'll be making will be talking about, we are still on the beginner stage, you understand, but in the second video we will now enter module 2, which is the market structure fundamentals. You understand? The first module, the module 1, we've talked about forex basis, just the basis of forex. That's what we've talked about now. You understand? Then the second one, which is module 2, we are going to be talking about market structure fundamentals. Okay guys, if you find this video helpful, don't forget to like, share and subscribe, and turn on the bell notification so that anytime I drop videos you'll be notified. Thank you guys.